Every single second you listen to this deep dive, the U.S. national debt clock is spinning faster than a slot machine.
It's unbelievable, isn't it?
It's currently speeding past the $36 trillion mark, and by the time we're done here, well, that number will have grown by millions more.
And when you look at that colossal figure, it looks exactly like what it is. It's a ticking time bomb.
Right, threatening to derail the entire global financial system.
And that visceral fear is exactly where this investigation has to begin, because most people, most retail investors, they see that $36 trillion number and they are asking the wrong question entirely.
Okay, what's the wrong question?
They're terrified of a traditional, visible, almost Hollywood-style financial crash. They're waiting for the moment the banks fail, the checks start bouncing.
The ATM stops spitting out cash.
Exactly. A formal, a Chapter 11 bankruptcy for a country. A default.
But if we're conducting a real forensic investigation into this fiscal disaster, we have to start by just dismissing that common misconception.
You have to.
Because here is the terrifying reality, and it's probably the single most important piece of context for everything we're about to discuss. The U.S. government will never formally default on its debt, not in the currency it controls.
Why would they? I mean, think about it. They own the printing press. The very moment a bond payment is due, the Treasury can simply issue new debt.
And the Federal Reserve can just create the currency out of thin air to buy it.
It's the ultimate get-out-of-jail-free card. A man with a printing press simply never goes bankrupt in his own currency.
Which brings us to the core thesis of this entire deep dive, what we're calling the act of theft. If they won't default formally, how do they solve a debt problem that is, it's mathematically impossible to pay off through normal means?
Right. And the smart money, we're talking institutional investors, the large capital managers, they understand this. They know we are not heading for a sudden crash.
No, we're heading for something far more insidious, something slower and far more calculated. We are heading for a silent default.
The silent default. It's the liquidation of debt through currency debasement. It's a slow, systematic confiscation of your purchasing power, disguised under the pleasant-sounding banner of targeted inflation.
So think of it this way. The government doesn't stop paying the bonds.
Never. They just ensure that the dollars they use to pay you back buy less and less and less every single year.
The dollar in your pocket isn't dying in a sudden collapse. It is being deliberately murdered by the people who control the money supply.
And the victim is the saver.
Okay, let's unpack this. Our mission today is to open the file on financial repression. This is not some theory we're inventing. It is a deliberate historical strategy, a documented playbook used by governments to liquidate massive debt by stealing value directly from you, the individual who is responsible enough to save.
We're going deep into the crime scene. We're going to uncover the motive, the method, and the tools they use to execute this hidden tax.
All right, to understand the motive for this crime, you just have to look at the math, because the math is now, well, it's fundamentally broken.
It is. This is what we call the debt spiral. For decades, when interest rates were pinned down near zero, the government could afford to owe $30 trillion.
Yes. The annual interest payment was pretty negligible compared to the overall budget. It was easy to look away and just pretend the debt didn't matter.
But that era of free money is completely, totally over. We are now operating in a new, high-gravity fiscal environment.
And that shift in interest rates is the crucial context. It's what turns a nuisance into an existential threat.
Yes, because when rates rise, servicing the debt becomes mathematically impossible without extreme measures. And in 2024, we crossed a terrifying line, a line I don't think we can uncross.
What was that?
For the first time in history, the U.S. government spending on interest payments on the national debt exceeded the entire national defense budget.
I want you, the listener, to just stop and let that sink in for a second. We're talking about the combined cost of the Army, the Navy, the Air Force, the Marines, military R&D.
Everything. The total cost to secure and defend the nation.
And we are spending more money just to service the debt, just to pay bondholders the interest that's due.
We're prioritizing debt service over national security.
That fact alone has to be the textbook definition of a debt spiral.
It is. Think of it like a credit card bill you just can't afford anymore. To pay the interest that is due this quarter, the government has to borrow more money by issuing new debt.
Which, by definition, increases the principal debt.
Right. And that larger principal then increases the interest payment in the next quarter. It is a mathematical loop of death from which there is no easy exit. It's an engine that only accelerates, feeding on itself.
So we've established the problem isn't political anymore. It's fiscal inevitability. So if the math is broken, what are the theoretical ways out? We analyze the sources, and fiscally it looks like there are only 3 theoretical doors of escape from this debt spiral.
And the political establishment has effectively bolted 2 of them shut, leaving only one option.
Door number 1, austerity.
This is the simple, painful, responsible solution. You drastically cut government spending, you balance the budget, and you start paying down the principal.
But let's be realistic here. We can immediately rule this out as politically impossible.
Completely. The 2 largest entitlement programs, Social Security and Medicare, make up the majority of non-discretionary spending. No politician who wants to survive the next election cycle will dare touch those programs.
And the demographic weight only makes it worse. The baby boomer generation is retiring en masse, which increases the cost of these entitlements exponentially.
To enact the kind of cuts you'd need to balance the budget, you'd have to slash those programs so deeply it would trigger social revolt. Austerity isn't just unpopular, it's politically unviable in a democracy.
Okay, so door 1 is closed. That brings us to door number 2, growth.
Ah, yes. The optimistic hope often peddled by politicians. The idea that we can just grow the GDP, the gross domestic product, faster than the debt is accumulating.
So the economic pie expands rapidly enough, and the debt-to-GDP ratio shrinks naturally, even if the absolute debt number is still high.
That's the theory.
But tell me, is the U.S. economy showing the kind of dynamism that we saw after World War II? The last time we faced a debt crisis of this magnitude?
Unfortunately, no. This door is locked by demographics and structural economic issues. The workforce is shrinking relative to the retired population. Productivity growth has stalled, not just here, but globally.
So we're not experiencing the kind of multi-decade, productivity-driven boom that could just absorb $36 trillion in debt organically.
We're not even close. The growth rate required to outpace debt that's currently growing at around, say, 6 to 7% annually is just, it's unachievable. We would need a sustained 8% GDP growth for a decade.
That's science fiction right now.
It is.
So we closed door 1, austerity, as politically impossible. We closed door 2, growth, as demographically and structurally impossible. That leaves us with only door number 3.
Inflation.
This is the chosen path. It's the only remaining lever available to the political class to escape this mathematical impossibility without causing immediate, visible public panic.
When you can't pay the debt through cuts or through growth, you have to print the difference. You debase the currency to make the outstanding debt load effectively smaller in real terms.
And the smart money, they see this. They aren't waiting for some political announcement.
No, they're just observing these mathematical constraints and positioning for the inevitable flood of liquidity. They know that when the government has to choose between defaulting on bond payments, which would cause a visible crash, and defaulting on the currency's value,
The silent default.
they will sacrifice the currency every single time. It is the path of least political resistance.
That necessity, the need to choose inflation, brings us directly to the smoking gun in this case. Because the silent default isn't a new invention. It's a historical playbook, and we have been here before.
We have. We need to look at history as precedent for the crime, because the evidence is, well, it's shockingly clear.
The current situation feels like history rhyming very, very loudly.
Extremely loudly. In 1945, after the massive spending required to win World War II, the U.S. debt-to-GDP ratio spiked to 120%.
That specific number is remarkably similar to where we sit today.
It is, especially if you factor in the massive unfunded liabilities like future Social Security and Medicare obligations. Some conservative estimates put the true long-term fiscal gap much, much higher than 120%. The debt was monumental, just like today.
So how did they fix it? Did the U.S. government declare bankruptcy? Did they endure the painful cuts of austerity?
No. They engaged in the precise mechanism we are investigating today. Financial repression.
Financial repression. I mean, that's the definition of the silent default.
It is. It's the deliberate, coordinated strategy by the Treasury and the Federal Reserve to liquidate sovereign debt by keeping real interest rates negative. The mechanics of the theft they used between 1945 and 1955 were brilliant in their simplicity.
Walk us through those mechanics. How did they actually pull off the theft?
The Federal Reserve capped interest rates, specifically on long-term government bonds, at a very low fixed level around 2.5%.
So they just set a ceiling.
They set a ceiling, and they enforced it by stepping in and buying bonds whenever yields rose above that target. But, and this is the key, at the same time, they deliberately allowed inflation to run hot, Post-war inflation often spiked up to 6, 7, even 10%.
Wow. So they created a massive gap between the price of money, the rate cap, and the actual value of money, which is inflation.
Exactly.
Let's analyze the arithmetic of confiscation here, because this is where the theft becomes just undeniable for the average citizen.
Okay, so imagine you're a WWII veteran, a conservative saver, maybe a pension fund manager.
Mhm.
You held a long-term treasury bond, and it was earning you a guaranteed 2.5% yield.
Which felt safe, rock solid.
Right. But simultaneously, the cost of living, the price of groceries, a car, a new house, was rising at 7% per year because of that intentional inflation.
So you're systematically losing 4.5% of your wealth every single year in real terms.
That's the math. The government wasn't defaulting on the promise to pay you 2.5%, but they were ensuring that the 2.5 cents you received bought 4.5 cents less than it had the year before.
It was a perfectly designed confiscatory tax on savings, unlegislated, unvoted for.
And completely opaque to the average person who only saw the 2.5% deposit hit their account.
For an entire decade, the government essentially performed a massive wealth transfer from the conservative bondholder, the responsible saver, directly to itself to pay down the cost of the war.
They didn't pay the debt off with surplus tax revenue, they just inflated it away.
And that inflation is the smoking gun that confirms the silent default. By 1955, the debt-to-GDP ratio had collapsed.
It had. But not because of massive budget surpluses or austerity. It happened because the purchasing power of the outstanding debt just evaporated,
The nominal value, the numbers printed on the bond certificate, stayed exactly the same.
which allowed politicians to claim they never defaulted.
But the real value, the actual money inside that bond, was systematically stolen. It was melted away by inflation.
And the terrifying realization for us today is that the modern Fed is positioning all the pieces for the exact same board game. When we see policy decisions that seem insane under free market economics, they make perfect, brutal sense under the umbrella of financial repression.
The victim of 1945 was the conservative saver who funded the war. The victim today is the everyday citizen whose retirement is sitting in low-yielding cash or fixed-income assets. We've established the mode of unpayable debt and the precedent, the 1945 playbook. Now we need to look closer at the tools of the crime. How do they execute this theft today in our modern hyper-digital financial system without setting off global alarm bells?
Well, the execution requires some sophisticated plumbing, and the first, most critical tool is the one they use to repress yields. We call it yield curve control, or YCC.
Okay, to understand the crime, you have to understand the rule they're breaking.
Yeah.
Let's start with the basics. What should a yield curve look like in a healthy market?
In a normal free market, the yield curve slopes upward. That just means a 1-year bond should yield less than a 10-year bond. Because a bondholder is taking more risk by lending their money for a longer period of time, and they also need to be compensated for the long-term risk of inflation. If inflation expectations are high, say, 5% bond investors would demand a real return.
Meaning the yield on that bond has to be significantly higher, maybe 7 or 8%, just to compensate them for the inflation risk.
Exactly.
And we know the government absolutely cannot afford to pay 7 or 8% interest on $36 trillion of debt. That would accelerate the debt spiral instantly.
It would lead to visible insolvency within months. So, to prevent rates from reflecting this market reality, the Federal Reserve steps in and deploys YCC.
The Fed becomes the buyer of last resort.
That's the term. They print new money and use that money to purchase massive quantities of treasury bonds, primarily the long-term debt, the 10-year, 20-year, and 30-year bonds.
So by injecting this massive, basically unlimited demand, they artificially force the price of the bonds up.
Which, inversely, forces the interest rate, or the yield, down.
That is the mechanism of repression.
It is. They are rigging the game against the bondholder, ensuring that the yield they receive is consistently below the rate of true inflation. The result is a guaranteed negative real rate of return, the very definition of financial repression.
So YCC is the active suppression of market reality, keeping the government's borrowing costs artificially low and just transferring the cost of that debt directly onto the saver.
That's the primary weapon.
But there's a second, more complicated mechanism that acts as the financial plumbing for this whole operation, and that's the reverse repo facility, or RRP. It feels incredibly abstract, like a giant black box.
It is abstract.
Explain this tool and why it matters to the average citizen.
The RRP is essentially a sophisticated monetary mattress, or you could think of it as a federally subsidized savings account for very large financial institutions, like banks and money market funds.
Okay.
When the Fed prints money through quantitative easing, or QE, That cash floods the system. Sometimes there's too much cash, and the Fed needs to vacuum some of it up temporarily to keep short-term interest rates stable.
And to prevent headline inflation from spiking out of control.
Exactly. So the Fed pays these banks to park their excess cash with them overnight.
So why is that important for the silent default? How does that play in?
Because it allows the Fed surgical control over liquidity, which is crucial for managing the appearance of inflation. Think of it as a massive pressure valve.
A pressure valve, okay.
If the Fed prints too much to fund the government and they start to see the public notice inflation, they can temporarily drain that excess cash out of the system by incentivizing banks to use the RRP. It acts like a giant sponge pulling money out of circulation.
Which temporarily hides the inflationary pressure.
And keeps short-term rates stable. It is financial sleight of hand. It's designed to confuse the public and manage short-term optics.
So they move the money from the left pocket, the open market, to the right pocket, the Fed's balance sheet, to maintain this illusion of control.
Precisely. They drain liquidity when public opinion demands inflation control, making it seem like they're fighting rising prices. But they can pump that liquidity right back in when they need to make sure the government is funded and the bond market doesn't seize up.
So the RRP is a key tool in this shell game. It ensures that while the total amount of currency creation expands, the underlying debasement continues, the Fed can modulate the speed and location of the resulting inflation.
Yes. And crucially, this modulation ensures the inflation moves primarily into asset prices first, which benefits the insiders, before it hits consumer goods, which is what causes public panic.
These tools, YCC and RRP, they're the hidden mechanisms that allow this silent liquidation of savings to happen while maintaining a facade of stability.
It's theft executed with complex mathematics.
This brings us directly to the moral dimension of the crime, because inflation is not some neutral economic force. We're talking about theft here, and the question that needs answering is, who pays this hidden tax? Who is the ultimate victim in this forensic file?
The ultimate victim is the wage earner and the conservative saver. This is where we have to introduce the Cantillon effect, named after the 18th century economist Richard Cantillon.
Right.
His profound realization, which is often ignored today, was that money is not neutral. When new money is printed or created, it doesn't just magically appear everywhere at once, diluting value equally. It enters the system at specific, concentrated points.
Let's call this the spigot hierarchy, and let's make it modern. Who are the first receivers of the newly created liquidity today? Who are the beneficiaries of this hidden tax?
The first receivers are, as they always have been, those closest to the creation spigot. This includes the massive Wall Street banks and financial intermediaries that participate directly in the Fed's bond buying program.
So YCC and QE.
Exactly.
So.
It also includes large government contractors and corporations that receive massive federal spending. They get to spend that new money before it has had a chance to dilute the overall money supply and raise consumer prices.
So they're using dollars that are worth 100 cents, or maybe even 105 cents if they're leveraging, before the inflation really hits the grocery store.
That's the key. And what do? They buy stocks, complex financial instruments, high-end real estate, art driving up the price of assets they already own.
This is the core mechanism of wealth disparity.
It is. By the time that money trickles down through the economic system, from the banks to the corporations and finally to the wage earners, the damage is already done. Asset prices are elevated, and critically, the cost of oil, food, and rent has already doubled.
So the dollars they receive as wages have lost significant purchasing power.
The last receivers, the teacher, the factory worker, the retail employee, the small business owner, they get that money as wages or small savings increases after the inflation has already been generated.
So they're effectively paying for the bailout of the bankers and the government's insolvency through a hidden tax they never ever voted for.
That distinction, spending first versus receiving last, is the key to understanding why inflation is such a uniquely regressive and, frankly, ethical crime. It hits the poor and the middle class hardest. It confiscates their savings and punishes the very act of saving money, which we traditionally view as a virtue.
It's a punishment for being fiscally responsible.
Yes.
So the verdict on the saver is clear. In a silent default environment, the financial dynamics are completely inverted, turned on their head. The middle class, who hold their wealth in cash or low-yielding savings accounts, they just have to watch their resources melt like an ice cube in the sun.
Their cash becomes a liability. It guarantees a negative real return.
Meanwhile, the informed investor, who owns assets and can access cheap, fixed-rate loans, benefits massively.
Massively. They borrow depreciating money to buy appreciating assets. Their debt, ironically, becomes an asset because it gets paid back with dollars that are worth less tomorrow than they are today.
The silent default widens the wealth gap by design. It ensures the people closest to the money creation spigot are the first to benefit from the solution to the debt crisis. We have to broaden our forensic investigation now and look at the global witnesses to this crime. The U.S. successfully executed financial repression in 1945 because it was the only major economic power left standing. The world had to buy U.S. debt.
There's no alternative.
But in 2025, there is a fundamental and deepening threat to the feasibility of this operation. The world is actively walking away. We're seeing a massive acceleration of the de-dollarization trend.
This is the major risk differentiator between the 1940s and today. In the 40s, the U.S. dollar was the only game in town. Today, that hegemony is being actively challenged. The BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding bloc of allies are openly and actively building payment systems designed specifically to bypass the U.S. dollar infrastructure.
Why this urgency from these global partners?
Because they recognize the mathematical impossibility of the $36 trillion debt spiral. They understand financial repression as well as we do. They do not want to be the victims of the U.S.'s coming silent default.
So if they hold massive quantities of U.S. treasuries, they're just holding certificates of future confiscation.
Exactly. They are lending money to a country that fully intends to inflate it away.
The most tangible, indisputable evidence of this global flight has to be central bank action. These aren't hedge funds or speculative retail traders. These are the collective smartest, most informed monetary authorities in the world. What have they been doing?
Their behavior over the last 2 years is screaming alarm. Central banks have been buying gold at the fastest pace in 50 years. This isn't theoretical. This is a calculated strategic rotation out of dollar-denominated assets.
China, in particular, has been systematically reducing its holdings of U.S. treasuries month after month.
And exchanging those paper promises for physical gold.
They are literally trading paper promises for physical truth. It's a fundamental statement about the long-term trust in the entire fiat system.
And this creates a severe funding problem for the U.S. Treasury. When the biggest historical buyers of U.S. debt like China and Japan decide they no longer trust the long-term solvency of the dollar, they stop buying treasuries.
And when they stop buying, who has to step in to keep the interest rates artificially repressed through YCC?
The Federal Reserve. This forces the Fed to print even more new money to soak up the excess supply of bonds, which just accelerates the silent default we talked about. The flight from U.S. debt is forcing the U.S. government to commit its financial crime faster.
This flight from dollar debt has also fundamentally compromised one of the central pillars of traditional financial advice, the 60-40 portfolio.
Oh, absolutely.
For decades, every financial advisor told everyone to put 60% in stocks for growth and 40% in bonds for safety. The bonds were supposed to be the hedge. When stocks crashed, bonds were supposed to go up.
That theory is functionally dead in an era of financial repression. The safety mechanism relied on bonds acting inversely to stocks. But when the primary threat is inflation, the silent default inflation hurts both asset classes at the same time.
It debases the currency that stocks are denominated in, but it absolutely annihilates the fixed return of bonds.
Exactly. We saw this play out dramatically in 2022. It was the worst year for the 60-40 portfolio in a century.
Both asset classes collapsed together. The traditional safe haven was completely compromised.
If you are holding 40% of your retirement in long-term government bonds today, you are effectively holding 40% of your retirement in a burning building. You are sacrificing wealth on the altar of the government's fiscal necessity.
That's why the sophisticated institutional investors have already abandoned the 60-40 model.
They've moved on. They've moved to what is called the endowment model, prioritizing real assets, private equity, commodities, things that hold value or produce cash flow regardless of currency debasement. They recognize that what used to be safe government bonds are now correctly categorized as return-free risk.
They offer low nominal yields and a guaranteed, mathematically enforced, negative real return.
The cornerstone of traditional financial advice is gone. The listener fundamentally needs a new operating manual.
So we've completed the forensic investigation, the crime is ongoing, the motive is fiscal inevitability, and the tools are in place, actively melting the purchasing power of the dollar. So what is the exit strategy? How does the individual saver escape the melting ice cube?
You must fundamentally change your operating model. You have to go from being a saver of currency to an owner of assets. You must recognize that fiat currency, the dollar in your bank account, is now the melting ice cube.
And your goal is to trade that melting asset for the unsinkable boat.
Exactly. Something that is finite, that is hard, and that is outside the control of the printing press. The entire rotation is based on one core principle: scarcity. In a world where paper money can be created infinitely by political whim, safety is found only in the finite.
Let's look at option A, escape into hard assets. We'll start with gold, the traditional choice, the one central banks are now hoarding.
Gold is the anti-fiat. It is the only currency central banks cannot print more of. Its value is recognized globally because of its physical, undeniable scarcity, its history, and the difficulty of extraction. For central banks, buying gold is the hedge against their own political necessity and institutional incompetence.
And for the individual investor, it serves the exact same purpose.
The exact same. It's wealth preservation outside the fiat system. It preserves purchasing power over centuries. It's the ultimate store of value when confidence in government debt just evaporates.
And the modern digital iteration of that hard asset is Bitcoin.
Bitcoin represents the purest, most transparent form of scarcity ever invented. It is the only asset with a mathematically capped supply, fixed forever at 21 million coins. It is an engineered escape hatch from the fiat system entirely.
Its value proposition is simple.
Very simple. Because it's immutable and decentralized, you cannot inflate it away, and no single government or central bank can seize or devalue it through policy. As the silent default accelerates and trust in institutional governance collapses, hard-coded scarcity becomes the ultimate premium asset. It's the digital lifeboat.
Okay, that's the direct escape into scarcity. But there's also option B, which is favored by many institutional players. Outpace devaluation by using debt.
Right.
This seems counterintuitive, especially when we spend so much time discussing the dangers of national debt. Why would more debt be a solution for the individual?
But this is the key to the smart money playbook. Debt itself isn't the problem. It's who owes the debt and what it's denominated in. If you, the individual, can borrow cheap, fixed-rate debt, say, a 30-year mortgage at a low rate, and use that debt to acquire cash-flowing assets,
Like real estate or farmland.
then you win big in the silent default environment.
Why real estate or farmland specifically?
Because land is finite. Billionaires and institutional funds are buying up farmland and commercial property because those assets are inherently scarce and their value is denominated in real terms, not paper dollars. They are also essential. People have to eat. Businesses need space. Their rents and cash flows rise with inflation.
I understand the asset side of that, but let me push back on the liability side. If I buy real estate, I face property tax, maintenance, insurance, the inherent illiquidity of the asset. Is that truly an unsinkable boat, or am I just trading the risk of inflation for the risk of asset complexity?
That's a crucial distinction. You're trading melting capital for productive capital. And while that complexity exists, here is the crucial financial advantage in a silent default. You borrowed a high-value dollar today, say, a dollar that required 3 minutes of your labor to earn. You are paying back that loan over 30 years with dollars that are constantly being depreciated by inflation.
So inflation literally pays off the loan for you.
It does. The dollar you pay back in year 25 is worth dramatically less than the dollar you borrowed in year 1. If inflation averages 4 to 5% over that period, the amount of real labor required to service that debt shrinks every single year.
So the asset you bought appreciates with inflation, while the liability, the fixed debt, shrinks in real terms.
You've leveraged the government's need to inflate away debt to your personal financial advantage.
So the final debate for the listener is simple. The entire strategy comes down to a fundamental bet on the future behavior of the political class.
Precisely. If you hold your wealth primarily in dollars, cash, or traditional low-yield government bonds, you are betting that the politicians in power will suddenly find the courage and responsibility to implement austerity.
You're betting on virtue. You're betting they'll raise taxes massively to pay down $36 trillion through responsible means.
And if you rotate into hard assets, gold, Bitcoin, real estate, using fixed debt, you are making the opposite bet. You are betting that politicians will continue to be irresponsible, continue to choose the path of least political resistance.
And accelerate the silent default. You are betting on necessity.
Looking at the trajectory of the $45,000 per second debt increase, you just have to decide which bet is safer and more grounded in reality.
Let's summarize our forensic findings and give the listener the smart money playbook summary, the verdict.
1. Get out of the yield trap.
Yeah.
Long-term government bonds, especially in this environment, are certificates of confiscation. They are the instrument through which the government is actively stealing your wealth.
They guarantee you a negative real return. That wealth has to be liquidated.
2. Minimize cash. Keep only what you absolutely need for short-term emergencies and transactional use. The rest is melting capital. It is not a safe haven. It is the primary victim of the silent default.
Every day that money sits there, it is paying the government's hidden tax.
3. Own hard assets. Allocate wealth to assets that cannot be printed and cannot be controlled by central decree. Gold, Bitcoin, specific commodities, real estate. Focus on scarcity and immutability.
Get outside the fiat printing system.
And 4. Use good debt. Borrow cheap fixed-rate debt to acquire cash-flowing, appreciating assets. Let the inevitable inflation generated by the government's political necessity pay down your liability for you.
The rules have changed entirely because of the mathematical impossibility of the sovereign debt load.
They have. The traditional saver, the person holding cash and bonds, is now, by necessity, the loser. The owner, the person who owns the finite, income-producing asset funded by depreciating debt, is the winner.
Do not allow your past labor, which you stored in the form of cash and savings, to be stolen from you by a printing press, controlled by politicians who have run out of options. The only question left is, do you adjust your portfolio to reflect the world as it should be, or the world as it is constrained by political necessity? Audit your wealth through the lens of scarcity and political choice, or pay the hidden tax.